Hello, hello, hello. Am I live? And let's see. I am live. Let me check this. Checking 1 2 1 2. Trying to get this live working, and apparently it is not doing well. I don't know what's happening. Says I have an excellent connection, yet it seems to be buffering. Let me know if you guys can hear me. What's up, John Beck? How you doing, man? All right, looks like we're getting some viewers here. Let's see what's going on. So today the federal rate remains the same. They still the target range federal funds rate at 4.25% to 4.5%. Nothing's changed there. We're gonna listen to Fed Chair Powell, see what he has to say, see if he sounds dovish or we'll see what's going on with that. But obviously, it was a 97.9% chance that it would remain the same, which it did. So no big surprise there. Eventually, I think one of these times they may surprise us, but I could be wrong. What's up, John Beck? What's up, Nalesh and Donna? How you guys doing? Make sure you guys smash the thumbs up if you guys are in here. We're going to start giving away promo codes again. We're going to do it a little different this time. I'm going to do it on my daily videos.
Good afternoon.
So, here we go.
My colleagues and I remain squarely focused on achieving our dual
See what
mandate
he's
goals
talking
of
about.
maximum employment and stable prices for the benefit of the American people.
Can you guys hear it good?
Uncertainty, the economy is
Let me know if you guys can hear the
unemployment rate remains low,
stream.
and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2%
Turn it up a little bit.
objective. In support of our goals, today the Federal Open
What's
Market
up,
Committee
Dijon?
decided to leave our policy interest rate unchanged. Economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year.
Oh, sorry, guys.
Wage growth has continued to moderate while still outpacing
Jerome
inflation.
is super quiet.
Overall,
see
a
it.
wide
Let me
set of
turn it up a little
indicators
bit more.
suggests that conditions in the labor market are broadly in balance and consistent with maximum
See
employment.
if you can hear that now.
Inflation has eased significantly from its highs.
Or let's see if we can find a different channel. Maybe it'll sound a little better.
Have remained solid. Payroll
There we
job
go.
gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time before adjusting our policy stance.
Here, let's see if that'll help.
We see our
my
current policy stance as
stream
appropriate
a
to
little
guard
bit.
against
I
inflation
don't know what's
risks.
going on with it. I'm not getting
We're
the
also
right
attentive
bit
to
rate.
risks on the employment side of our mandate. In
So
coming
frustrating.
months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Uh-oh, here we go with the questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive.
YouTube sucks, guys.
Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So, just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting?
Hit 1 if
Is
you
that
think that they're
potentially
gonna
adequate to make a decision to
lower
lower
rates
at
in
that point?
September.
So you're right, we do have.
Hit 2 if you
this is
think they're gonna remain the same. Hit
intermediate
3
period when
if
we'll
you
get
think they're
2
gonna
full
raise them.
rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had
Oh, what's happening now? Come on. Oh, I guess we'll pick a different channel. Thanks, Yahoo Finance.
We're very close to
There we
the
go.
end of that process, and that's not
CBS
for
is
us
going
to
right.
judge. But it feels like there's much more to come, as well, looking ahead.
Neil. Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is
There you go. I put a
restrictive
poll on
right
there to
now,
make it
given
easier.
current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the
there's
labor
always a
market,
but.
what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance.
You think AI is going to make a big
partially because
change
both demand
to the
and
labor
supply
market?
for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable. Which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment. Not so much
Rudy,
growth.
if they lower
the labor market
rates, it makes
looks
money
solid.
worth less. So
Inflation
it's
is
another way to
above
create
target,
more
and,
inflation.
even if you look through the tariff,
A strong dollar needs higher rates.
and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there
Downside risks to the labor market.
Get on Friday that would.
Do you think AI will have a big
equilibrium
change
job
in that?
growth?
Let me know.
The main number you have to look at now is the unemployment rate, because if it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year.
Bitcoin's dropping a little bit.
And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the
Feel
table.
free to
where,
put your
people
thoughts in the chat
thought
below
carefully about
if
this
anything
and
sparks your
put
interest
their
here.
positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation.
And make sure you guys hit that like button.
Maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear
Not
thinking.
a very
and-
talkative
and,
group tonight, huh?
Expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you ask about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are
Make sure you
there are a
guys
range of
answer the
views of what
poll.
neutral
We're gonna
rate
look over
is
that
at this
here in a
moment,
few.
for our economy, and so others may say it's more restrictive or less
Sorry,
restrictive.
guys, my battery just died on my camera.
We're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate, and that is our destination, because really we understand that no one actually knows what the neutral rate is.
Things
We
are
know a
very
price
bad.
works,
People are suffering far
and
away.
that will be how the way the economy reacts
They are.
over time to, slightly looser policy.
This might be a bad time, but I'm getting into the real estate business, and homes are really high right now, which makes rent high. I honestly don't know how some of these people are
My
paying
question is
rent,
about what
and
have you
even in
learned
bad areas.
over the last few months about the inflation generating and price
I would like to hear them
pass-through
talk about
process.
that.
And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is
So
only starting to be
15%
settled
of
with
you
some
thought
these more recent
think
deals. Given the
they'll
lag
raise
between
rates
when
in
tariffs
September.
are announced
35%
and
of
when they
you
show up
think
in
they'll
goods prices,
lower rates in
is 2
September,
months a
and
long enough horizon
50%
to
think
evaluate
they'll
the impact
remain the
and
same.
confidence
We'll check this again here in a little bit and
tariffs
see if it
aren't
remains the
impacting the
same.
broader
But I think that's
inflation
pretty
process.
I think you have to think of this as
pretty
still
much
quite
where
early
people are
days.
at.
And so I think what we're seeing now is
a raise would make sense.
substantial
A lot
amounts
of people
tariff
don't think
revenue
that, but I
being
really do think
collected
a
on the
raise
order
would
of
make
30
sense.
billion a month
But we'll see what
versus,
happens.
Substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through
Yeah,
exporters
flex.
lowering their price. And companies,
Yeah,
or
with the
retailers,
price
sort
of things, I
people who are
really
upstream
don't
entities that are
understand how
upstream
people
from the
are
consumer are paying most
making
of
it
this
off of
for
like
now.
minimum wage
Consumers
jobs. And
it's starting to
stuff.
show up
I
in
mean, it's
consumer
bad.
prices, as you know, in the June report.
We need a
expect
strong
to see
dollar.
more
The
of
only way
that.
to make it strong
And
is
we know
raise
from
those
surveys
interest
that
rates.
companies
Remember in the
feel
80s,
that they have every intention of putting this through to the consumer, but the truth is they may not
But
be
who
able to in
knows?
many
They might
cases.
lower it
I
and
think
just really
we're just gonna have
crush
to watch and learn empirically how much of this
normal,
and over
everyday
what
people.
period of time.
Which
I
is
think
sad.
we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic, expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking
Right, man.
through
I mean,
goods
we'll have to
inflation
see.
by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that.
Sorry about the camera being down, guys.
I don't think.
No, you're gonna miss
I
my
think
beautiful
the base
face.
case. As I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn
Polls
out to
still
be
remaining the same.
inflation, because we'll make sure that it's not. We will, through our tools, make sure
They
that
never
this
did,
does not
Fairway.
move from being
Or far away.
a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it.
Thank you guys
if
that
you-
are
if you
smashing
move
that
too
like
soon,
button. I appreciate it.
you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
BTC going to dump to 13K to fill the CME gap. There's a gap all the
Michael
way
McKee
down at
from,
3,500 and a
Bloomberg
gap at
Television Radio.
9,700
The
also.
One big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026, and would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we
American
don't
Dream
express
did
any
that.
judgments or anything like
It
on
sucks
fiscal
too because
legislation.
like I said, I'm
Legislation
looking
for
at
that
buying
matter.
some houses,
But
and
I would say when you think
I'm actually
that,
going to go tomorrow, look at a
the
few.
biggest part of the bill was making
And what I
permanent
am going to be
existing
charging
law,
for rent is
on
ridiculous,
taxes.
and that's just to cover the mortgage,
I
right?
don't think we see it as particularly
It's
stimulative. There should
insane.
be some stimulative effect.
I mean, it's
but,
literally
it
some of the
shouldn't be
neighborhoods that I've lived in the
over the next
past.
couple of years.
And to
The
follow
rent
up,
is.
what do you, well,
I
don't wanna
owned
put
a
this in terms
home
of
in
you
a
and
neighborhood that
President,
wasn't
so
the
let me
best,
ask
but
it
it was
this
a
way.
nice home. But at
do
that
you have
time, renting in that neighborhood was
about
like
the cost to the
$500 a
government
month. Is
of
now
keeping
like
rates
$1,300.
elevated for longer?
And I mean,
in
that's
terms of
15
interest rate,
years, maybe.
charges.
It's nuts.
We have a mandate, and that's maximum employment and price stability. And it is It's not something we do.
Is anybody
to
into real estate here?
consider,
Like, do you own homes
the
and
cost to
rent
the
them
government
or anything like that?
Our rate changes.
Curious.
We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do.
Or how's
We
the
don't consider
rent
the
in your
fiscal
area?
needs of the federal government. No advanced economy central bank does that.
My
And it wouldn't be
suggestion is
good
just
for-
wait. That things
if we
are
did
going
do
bad.
that, it would be good neither for our credibility.
I mean,
nor for the credibility of U.S. fiscal policy. So it's just not something.
I don't know.
we
I think it's
take into
a
consideration.
definitely probably near the peak of the market for the housing. But if it does crash, I mean,
Hi,
it
Victoria
will
Guido
come
with
back.
Politico. When it comes to
I wouldn't
the
do anything
renovations
that's
of the
going to
Federal Reserve's
financially,
headquarters that the administration has been looking into,
bind
do
you,
you see their
but-
interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something
A
that happens
rental
very
house
often
far
that
away?
the,
You have a rental
the Federal
house,
Reserve
or
and
you
the
mean your
president come
personal
over,
house?
Let alone to visit a building. But it was a good
Miguel
visit.
said
Are there any
3,025 for
aspects
two
of
bedroom,
the
two
project
bath.
that they've raised
in
that you see
Santa
as
Rosa,
making you reconsider
California.
any aspects of the project?
California's always been pretty high. I
This
don't know if
project
that's
was
like
hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National
Yeah, that's
Capital
what it's
Planning
like in
Commission,
certain
and,
areas
a lot of
around
back and
here,
forth
but
there. It was very
like
constructive.
in the
We
city
started out
out
to do
here
the
is
work, and
cheap. There's a lot of
we're
rundown
very well
stuff.
along on that work, and I was quite pleased. to have the
Barway
president say
said, "I
multiple
pay
times
in
that
New
what he really wanted
Jersey
to see was
26,000 property
us
taxes.
getting this construction completed
Started
as soon
from
as possible.
6,500.
That is our
That's
focus,
nuts.
and,
That's absolutely nuts.
That's what we're
man.
going to do.
So mine is around 10,000, and where I'm at, that's extremely high.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year,
Yeah,
and then inflation
it's
turns
nuts.
lower, and a lot of
Honestly,
that may
don't know
just
how
be
some
an
people make
artifact.
it,
So
but
that's why we look at the
you can
12-month
tell because
numbers.
you can see people are letting their
think
houses
inflation
go.
is
They don't
most
have
of
the
way
money to
back
really
to
keep up
2%.
on stuff
There
as
are
much.
things like the
In
catch-up
a
inflation.
lot of
So, for
areas, I'm
example,
not
all the
saying all
insurance
areas,
costs
but you
that
will
are now-
notice it
they're
if you
only
look
now
around.
going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation. That
Yeah,
isn't
they need to
tariffs.
get
We're
rid of
always gonna be
property
dealing with the
taxes.
all of inflation, but the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you
So
comfortable
he
with
definitely
BLS
circled
continue
around that
performing
question.
their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too. So it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we
Where are you
continue
at,
to
Donna?
get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait and see approach is
The
giving
wait and see approach, what do you mean by that?
for cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait and see approach.
Well, so
sort of
that, that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs.
Here's the
which
video for a
possibly
minute.
could
For
lead
some
into
reason, my
more
battery
inflation
isn't
or more
charging,
inflation.
so I probably will
Is that giving
disappear
companies
soon
cover,
again.
though, to raise prices?
Well, what
Cape
may
Town,
be giving,
South Africa.
it's not our policy stance. What may be giving some companies.
What's the
will
average home
certainly be
cost
taking
out there,
advantage of the
Donna?
fact of the tariffs
Just
and
out of
all the discussion
curiosity.
of how they're going to. If the companies will raise prices when and as they can, and you saw it famously in the first administration of President Trump. During those tariffs, washing machines were tariffed, but dryers weren't. But what do you know? The price
What's
of dryers
Bitcoin
went up
doing?
too, just like washing machines. So companies will often just they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings
Ooh,
of
Bitcoin
whatever
is
the effects
dropping
turn
here.
out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay
Nice
some of
drop
this.
for Bitcoin.
But we're just going to have to see it through.
Like I said, watch for bounce right
But
around the
additional tariffs have been in place
115.
since February, and things really haven't broken yet with the economy.
115.5.
So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage? And
This is
maybe
what we
can't
were just
afford
talking about.
those rates?
What a
How do you justify
coincidence.
that? And
Well, so the
See what he has to
housing
say.
is a special case, right?
Housing special.
We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect.
They have a
but we're not
huge
the main
effect. They can't act like they don't.
There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize.
You know what? Let's do this.
So
let's kind of.
I think the best thing that we can
Let's
do
keep
for
Bitcoin
housing
in the big
is to
screen.
have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. We've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
There we go. Now we can keep an eye on Bitcoin.
Hi, Chair Powell. Thank you. Well, can you
definitely
give us a little
having
more
a
about
little
what kind of
drop here.
economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back?
Depends
nearly
on
to
township,
target?
but New Jersey is a
Are
nightmare
there
in
other
Texas.
things in the pricing that you
Michigan
look
didn't
for?
used to be
Do you
bad,
need
but
to
it's
see
gotten a
weakening
lot
in the job
worse.
market? What kind of things are you looking for?
I mean, ultimately, it's
1.5
it could be any
4
could be any of
million
those things,
rands.
right?
That's
But-
like middle
but,
class.
Okay,
thanks, Donna.
If you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we
He
take are
sounds
likely to be in
nervous
that
to me.
direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect.
Okay, I asked you guys what you thought they were going to do with interest rates.
You just need to see the number come
Now,
down.
put in the
closer to
comments
2.
below
We'll look at everything.
what you think they
As I
should
mentioned,
do?
a pretty
Not what
reasonable
do you think
base
they're
case
going to do, but what do
is
you think they should
that
do in
this will be a
September?
one-time
Do you
price
think they
increase.
should keep them the
And
same,
in the
lower
end,
them, or raise
we'll
them?
make sure that
Let me
that's
know
the
in the
case.
comments.
We're just trying to do that efficiently. And efficiently means getting the timing right, so we don't, again, if we cut rates too soon, maybe we
And if
didn't
I'm
finish the
talking
job
loud,
with
I
inflation,
apologize. I have the
because
headphones
history
on.
is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right. And,
Intel,
that's
I
effectively what we're
understand
doing.
that, but what do you think he should do is what I'm asking.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite
Oh, here we go.
heavily
Here's
this
a big
year.
question. Let's
I was
see what he's
wondering
got
if
to
there's
say
been
about
any
this.
discussion about that at the meetings and how, to what degree that may be complicating your attempts to get inflation back to target. Thank
So
you.
this goes back to the division of labor between the Fed and the Treasury, as you, I'm sure, know. And
Hold
you know,
or cut.
the Treasury
Nelly,
only,
why do you think that?
speaks to
What do you
this-
think
speaks to
it will
the dollar.
help if they cut rates?
It's not something that's been a topic of
That'll make everything cost more again because
major
money will be
discussion
cheap.
at all at the Fed. I won't say it doesn't come up.
Increase the rates. We
in
suffer,
transcripts when they
but
come
we
in.
can
They'll
hope for
probably
better
reflect some
days. If they
mentions of the
lower
dollar,
the
but it would
rates,
never
and
be
inflation
a
is
major
going to be
focus.
bad. Exactly.
Follow
That's
on, if I
my
may,
thoughts
to Andrew's
exactly.
Question. I think the amount of
Anthony said
imputed
raise them for a
data in
stronger
CPI now
dollar.
is up
Believe
to
that'd be very
35%.
beneficial. I believe
Is
the
there any
same.
discussion of that as well? Is there any
Again, it would
consideration
hurt.
of
It would
looking at
crash the markets, but it would put
alternative
everything
measures,
back where it
data
should
so
be
on, in
instead
order
of
to just
inflating shit
ensure you've
and
got a
making
good
things
read on
look
what's happening
like
to prices in
they're
the US
great because the
economy?
market's
Thank
going
you.
up. That
You
even
know,
the
we're-
market's
so we're
just
monitoring the
inflation.
situation.
That's
We
all it
do,
is.
Of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But at the same
Labor
we
market's
really
going to
need-
be in trouble
the
anyway
government
with
data really
AI.
is
If
the
you
gold
can't
standard
see that
in data,
already,
and we need it to be
it's coming
to
quick.
be good and be able to rely on it. And we're not going to be able to substitute for that, but you know, if we
But
have
yeah,
to make do with
mixed
what we have, but I
decisions. Some
certainly
people
hope that we
think
get
that cutting it's going to help.
what we
Some
need.
people think that raising it's going to help. I personally think raising it is what would actually make the dollar stronger and put the economy where it needs to be after a huge
Trump
correction.
has
But
obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that
I don't think people
conduct
understand
might impact the Fed's
the-
independence going forward?
I'll just say that
how big the
so
AI is going to
I
affect
think
the
that having
labor
an
market.
independent central bank has been an institutional arrangement.
You know, it used to be just
that has
robots.
served the
Now
public
it's
well.
thinking.
And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to
Learn to
have
code.
that, it would be a great
That doesn't
temptation,
help anymore
of course,
either.
To use
You can
interest
go
rates to
on and
affect
have
elections, for
Grok
example.
or any
And
AI
that's
really,
something
but
that
Grok does a
we
very
don't
good
wanna do. So
job
I think
of
that's
writing
pretty widely
code. You can
understood,
tell it what
certainly
you
it is
want
in
it to
Congress.
write, and it will
And,
literally write the code.
I mean,
it's crazy.
I think it's very important. I'll just say that.
Afternoon, Sir Powell.
Barhead in the
Maria
next
Luisa
few
Capurro
months
from Bloomberg
really
News.
depends on
You mentioned
the
a
Fed's
slowdown in
decisions
consumer
here,
spending,
or
and I wanted to see
you know,
if you could
a
walk
black
us through
swan,
what was the
but,
discussion with the
if
committee
everything
around
keeps going the
that.
way it
We've
is and
seen
inflating,
delinquency rates
then
rising for upper
things
income
just continue to
households.
go up.
How do
But
you
it's
see that
inflation.
evolving
It's
in the
not
next
real.
few months, and how much of a vulnerability
And
that
there
is
goes
for
my
the
camera
economy
again,
going
sorry.
forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape. And that
Credit
spending
card
is at a
company.
healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies.
Also,
I don't
for
know what to make
AI,
of
my
that. I
son
read the
is
same thing,
computer
but-
and
so
cybersecurity, and
generally
he said it
and
depends
if
on
you
who's
look at the
behind the
banks
AI.
and when the banks talk about in their earnings calls,
That's partially
the performance
true.
of credit has been
Partially
good.
true.
So essentially, you have a consumer that's in good shape and is spending, not at a rapid
But
rate.
AI is going to take over a lot of stuff. I
but
mean, you can literally
it's true. And
have
was-
it
again,
draft
right-
you
right in
legal
line with what we
papers that you
expected.
needed a lawyer to do before.
The
I mean,
GDP data that we got this week.
I'm sure
and
it'll
I
be
think
able
it's
to
still
take your
a little bit
taxes and
difficult
do
to
your
interpret
taxes
because
too,
you have these
easily
massive
for you.
swings in net exports, which may also be affecting. Some of that can be can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely.
I have a
but
feeling
we
it'll
also
make
watch the
less
labor market
mistakes
and
than
performance of
humans.
inflation.
Not saying
Those
it
are
won't make any,
Those are our two
but-
variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge.
True.
And he was
True,
pointing
far
to
away.
weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But look, I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but
that
so is the
trade's doing
supply.
pretty good.
So
I'm
that's a
gonna move my
balance.
stop
It's in
losses
balance.
down.
Oddly enough, you've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also, we know that because of immigration policy, really, the flow into our labor force is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable for.
AI,
they haven't really
it's an
moved a lot in a
algorithm
full
and
year.
depend on
So
who's
I think if you take the
going to
totality of the labor
programming.
market data, you've got a solid labor market. But I think you have to see that there are downside risks. It's not you don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against
There was
that?
the poll results.
Sure. So
At least,
we
it's
have
doing a
we
little
have an
though.
economic go around where people talk about the economy, and then the next, and that's yesterday, and then today we have a monetary policy go around. All the way around the table, everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target.
All right, I'm gonna
That
put
means
another
policy
poll up, guys.
policy
Make
should
sure
be
you
a little
answer
bit
this.
Restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, an unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock, and it's probably not surprising that there would be differences.
There you go.
different
Answer that poll
perspectives
for
on
me,
that,
guys.
as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. You know, I said that's why we think policy should be restrictive, is because, you know, inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal. So you have to, that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more you know, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and you know, we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9%.
There. No, I think anybody will be able to
suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks that the housing market is in fact weak.
I'm sorry, but politics is a Muppet show. It is.
GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see
next rate
from
meeting.
these
They
data
will
points before
panic,
you would
lower
be,
the rates
comfortable with
50% because
cutting in,
everything
say,
went
September.
bad.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2.
They're definitely doing a juggling act right now.
You mentioned the quarters. So those are slower, but, you know, GDP is bumpy quarter to quarter, half to half, and often gets revised, you know, after the fact. The labor market data we still think is, continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, you know, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not.
So
right now.
far, 50% says raise rates. 17 say lower the rates, and
I'm not gonna,
keep the rates the same, 33%.
I just think we're going to need to see the data, and it can go in many different directions.
I just wonder if people understand how the rates work, or are they just regurgitating what other people have said.
Data and based on that balance.
I think a lot of people really don't understand interest rates, what they do, what they affect, and how they affect it.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
Oh, and he's out of here. So basically a whole lot of nothing, like normal. No big wow moments or thoughts or anything like that. Basically just everything's fine, it'll be fine, we're gonna keep doing what we're doing. No economist or pundit has displayed a truthful understanding of tariffs from a historical perspective. Right, they have not at all. there's a lot of stuff people don't seem to understand for some odd reason. But that is that, and that's over. I appreciate you guys for coming in and listening to a whole lot of nothing with me. And I truly appreciate all you guys that are active in here and wanted to talk and ask questions and, you know, just give your thoughts and opinion. That's what makes, we don't see enough of that anymore. People need to give each other's opinions back and forth, whether they're the, you know, same, opposite, or whatever, without getting vile in arguments, things like that, man. So thanks again, guys, for tuning in. I appreciate it. Make sure you guys tag your notification bell to get you notified when I post new videos. I do daily updates every morning for Bitcoin markets, you know, a little mix with some altcoins in there sometimes. Also, if you guys want me to do more of the news segments like I had started, let me know. If you want to stick strictly to the charts, let me know that also. Really curious to what you guys would rather see. So, thanks again for tuning in. You guys rock. I always am, far away. I always am. I appreciate you guys tuning in. But I am going to get back to work. I got a lot of crap to do outside, so I'm going to get back to it. Maybe I'll start having poolside chats or something for the rest of the summer. Maybe once or twice a week, just sit down and have a poolside chat. All right. Thanks again, guys. Have an awesome night, and I'll see you guys in the morning. Take it easy.